Well, I think we have everyone ready. Good afternoon, everyone. I'm Catherine Howarth, Chief Executive of ShareAction, and I'm extremely pleased to welcome you for what I hope will be a fantastic, I know will be a fantastic discussion over the next hour on net zero finance and the role of public policy in driving the changes we need to see in the finance sector to in turn drive the change we need in the real economy to achieve 1.5 degrees. This is an event organised under the auspices of the All-Party Parliamentary Group on Sustainable Finance, and we have the Vice Chair of that group, who's also the Chair of the Net Zero APPG, Alex Sobel. And I just want to thank E3G for proposing this event and to highlight that they will be bringing out a parliamentary briefing next month in June on net zero finance. So do look out for that, and I'm sure it'll be sent on to you. So I hope we're going to have a really good discussion digging into what are the options and how far do we still need to go to implement the kind of financial services policies that will achieve the change we need. This morning, the IEA produced a fantastically powerful new analysis setting out a 1.5 degree scenario, highlighting that there's really no space at all now for new investment in coal, oil and gas. And yet, at the same time, this morning at the Shell annual general meeting, just 15% of investors in Shell rejected a proposal that incorporates a good deal more new capex and growth in Shell's fossil fuel business. So there's a gap to be closed. There's a lot of tensions, I think, in the between the ambitions that have been set out by players, particularly in the finance community, and the reality of the actions needed on the ground in terms of financing decisions and in terms of voting and stewardship decisions. So I hope we'll get into some of that really interesting terrain about what we need to do to close the gap between what people are pledging and what actually is delivered. Anyway, to open up the session, I'm very pleased that we've got Alex Sobel, who's the MP for Leeds North, but who is speaking to us from Manchester, just to give his thoughts on this agenda and share his perspective as a parliamentarian on the net zero challenge. Alex, over to you.
Thanks, Catherine. I didn't hear that about Shell. That's really disappointing. I think that I'm really here to, and I have to apologise for any background noise or anything that's slightly distracting. As Catherine, I'm in a cafe in Manchester because I've been on visit today as the Shadow Tourism Minister. But I'm mainly here to talk about the sort of legislative context and the policy context and going into COP. We've just recently had the Queen's speech. The Queen's speech was very disappointing on this agenda. There were no new bills at all in this arena. We've had the Environment Bill reintroduced, which really should have been passed. I mean, the Environment Bill really is a Brexit bill. It's about carrying over environment regulation, setting up the Office for Environment Protection and bringing in a new regime for that. And I was initially on the Bill Committee, which met very briefly prior to COVID, then broke for a long time, then came back. And that bill should have been done, dusted, really, by the time we Brexited, and if not, then by the time we transitioned. But we're still here, you know, nearly 6 months after the transition finished, and the bill is just going to come back to the House in the next few weeks. So this Queen's speech really had very little for us. But looking back slightly further, the last budget and the budget before, there's a lot there actually for the sector, and we can look at what was announced, but also what was missing or what we need to call for in future. So one of the big things is that we've got the green gilt, and NS&I are going to offer an opportunity for ordinary investors to invest in those investments. We've also got the super deduction, and the super deduction is going to be interesting to see how that operates. So there's a lot of critique of the super deduction, which is 130% tax incentive effectively for infrastructure investment, that it is just effectively going to be a tax break for organisations that were going to invest anyway, like your Amazons, which just near me in Leeds are about to just put planning permission in for a new warehouse, which is going to create 1,800 jobs, and they're obviously going to get that super deduction. Now, what it'll be interesting to see in a year or two what new investment on this agenda has been made and has utilised that super deduction. Whether the super deduction has made a difference, I'm not sure it has. It's not subject to any sort of climate tests. I would have been much happier if it had been a climate-related super deduction. Another area is that we've seen is the Prime Minister's 10-point plan, and I think it's the 9th or the 10th point. The 10th point is green finance and innovation, and within that there are lots of what I'd call green shoots for the sector. So there's £1 billion net zero innovation portfolio. I think that money's been really useful in terms of getting new projects up and running, getting proof of concept, giving some surety to investors for things. So things like floating offshore, tidal, CCS, which is the ongoing battle of CCS, whether we're actually going to get full-scale CCS that really works, some of the smart tech, etc. There's £100 million investment in that sort of direct air capture and CCS-related technologies, £100 million for energy storage and flexibility innovation. There's also all the money for fusion and nuclear modular. Let's see if that works. You know, people have very different views on nuclear. There's investment in hydrogen. Again, it does look like there is going to be some investment in green hydrogen, which I very much support. So the other area, which I think is coming through and being more discussion, although there hasn't been a very specific pledge in the budget, is around contracts for difference. So, you know, we're expecting a new round of contracts for difference. There's some mood music that's going to be expanded into areas like green hydrogen, into areas like tidal technology, which I think it very much needs to. We need a much bigger program, the CFDs, and we need ring fencing for other technologies that aren't offshore wind. The government are really keen on offshore wind. They're not so keen on onshore wind, and they're not so keen on other technologies. But we need all of those technologies to come through. We need government support to really sit behind the private finance sector to make sure those happen. I mean, the last area, obviously, is we've got COP coming up, COP26, and there's some big global issues where the UK can take some leadership. The UK has really failed in terms of export finance guarantees. In terms of energy, when I was in the Environmental Audit Committee, we did an inquiry into this, and 99.6% of export finance guarantees were in fossil fuels. That ban is coming in now, that moratorium, but we really need to see UK technology transfer, UK underwriting of new green schemes in the global south, and actually in countries where there is high levels of hydrocarbon production, so they can make that transition as well. Whether we think that they may necessarily need that underwriting or not, I think that it will, one, help UK PLC in terms of our export businesses, but also it will give that pathway, but also for countries that need that development path. And we need the UK to step up and really lead. And I think we've seen Joe Biden do this in terms of the global fund for investing in the just drops the headphone in the global south for COP. And what we need to see is a really big investment, a really big commitment going into Glasgow, which means that we can come out of that and we can get ensure that development pathway, the clean energy pathways, the low carbon pathway for those countries, so they can have their development, but they have it without coal, without oil, without gas, which is a real big challenge. But it's also what they want. You can talk to the governments of places like Fiji or the Maldives or the Seychelles, which I've done in the last few weeks, or the Caribbean countries. They want to make that transition. They want to make it low carbon, but they need our support to be able to do that.
Thank you so much, Alex. I'm going to come back to a lot of the themes you've raised, both the international picture, the Biden administration and other countries around the world needing our support. But I'm also really keen to pick up on your thoughts around how we build a really strong parliamentary caucus of support for some net zero finance and really build interest within Parliament for that agenda. So please share your thoughts on that later in the conversation. I'd like to bring in Steve Waygood, who's the Chief Responsible Investment Officer at Aviva Investors. Aviva is a leading light in this space, and that's greatly down to Steve's leadership, which is very much stretches beyond Aviva, very, very strong record of kind of thinking across the whole industry and internationally. So Steve, really interested in your reflections on where we're headed with net zero finance, what next, what more. Over to you.
Thank you. Thank you, Catherine. That's very kind of you. So also thank you for the invitation to be here. It's a pleasure. So we've been working on net zero now for best part of 2 years. And having come out with a commitment that we did 3 weeks ago, I mean, this is probably showing a bit too much, but it took over a person year. If you add up everybody who was involved in making it happen, it's a big undertaking. It's a big undertaking. We take the commitment incredibly seriously. It had to be signed off by the board, various subcommittees, the executive team, all the CIOs, all the chief investment officers, and a commitment, even if it is aspirational, such as the net zero commitment we made is, with a commitment to comply or explain. The sea change in the underlying portfolios is enormous. So it was not a commitment that we entered into lightly. And we're also quite well cited on the scale of transition that's required. Somebody recently said that all systems need to change. And this is the greatest system change challenge of all. Delivering a well-managed, smooth and just transition to net zero by 2050 has to be the global challenge of our generation everywhere in the world. It is for our clients that we're working on this, because of course they don't want to bequeath an unsustainable future to their children. It's also for our shareholders, because we've set out an argument that we think holds water, which is that our industry, the insurance industry collectively, has an existential crisis to climate change. So we actually think we've got a fiduciary duty to engage with this, if you like, macro stewardship conversation, engage with policymakers to help inform the debate and raise the alarm, almost with a canary in the coal mine as a sector. And if our sector falls over, which it might do, certainly towards the end of the century, business as usual suggests 3.5 degrees remains where we're heading. That's the implied temperature change in the London Stock Exchange. At that temperature, 74% of the world's population can't live where they do today. That level of migration is unconscionable. So as an issue that will test civilization as well as our business model and our sector, the question comes to us all, obviously, that's what we're trying to talk about. How are we going to motivate that level of change? And it will need support from investors. It will need our engagement and advocacy. And it was great that nearly 89% of investors did support that resolution on climate transition for Shell. I know that wasn't totality of support, but we did for Aviva's AGM about 2 weeks ago, 99.97% vote in favour for our TCFD report. So we've got, I think, Catherine, you'll be well aware of that, indeed. So we've got a lot of investors now raising their game and raising interest. So from a UK policy perspective, what can we do? There's the BEIS consultation on mandatory climate-related emissions disclosure. It's nearly a decade old from its first incarnation. It definitely needs to be updated to be consistent with TCFD and going beyond that, science-based targets and transition plans. So that would be a welcome policy move the UK can take. Some of the people watching this could take it forward. I was on the advisory panel for the Green Finance Strategy for the Treasury a few years ago. I was very disappointed that in the first meeting, fiscal measures were taken off the table. We need to revisit that strategy and put them back on that table, because it is only by internalizing the externality at source, making the polluter pay, that we will harness the profit motive and manage that transition. So we need to revisit the Green Finance Strategy. We also have MiFID II and the Sustainable Finance Disclosure regime in Europe, which need to be replicated in the UK at some point. Clearly, passporting will be an issue. But we have an opportunity there to build on what Europe has done. It's not a bad foundation, but it's not by no means perfect. And it certainly won't equip the end investors with the information they need to mobilize their voice and vote with their votes before they vote with their feet. So I think there's a much more considered approach that we can do with MiFID. And then obviously we have Cornwall and COP, and harnessing the entire international financial architecture so that all the financial regulators, all of the multilateral development banks, all of the internecine organizations that represent this international financial architecture, all of which were built post Bretton Woods, none of which were built with the climate crisis in mind. We need to revisit their mandates, just as Rishi Sunak did with Andrew Bailey and the Monetary Policy Committee and the Financial Policy Committee. It's that big. We can't just rely on the TCFD to disclose our way to the Paris Agreement. That's never going to work. Important though it is, that's just the first step in a very long journey. So sorry to make it so big, Catherine. I tried to be tangible with both the scale of the challenge and policy recommendations.
Steve, as ever, really good. I'm going to move on to the next speaker, but I want to just leave a couple of thoughts, things that I'd nice to come back to you on, Steve. One would be tangibly in terms of Aviva portfolios, what will look different as a result of the commitment that you've delivered as a firm, just so that can kind of come alive for people. But secondly, you've laid out a huge range of things from a policy perspective. I completely agree with what you've laid out. I'm just wondering, if you had to really prioritize something, where would you focus? So in terms of a message to parliamentarians, for example, at the UK level, what should they really start pushing for, get behind, to help kind of Alex and colleagues that are playing a leadership role within Parliament? What are the things that, from your perspective in finance, maybe this is something that Meryam and Nick, you can also think about, what do you think are the key things that UK parliamentarians should get behind to help move things forward and use the bandwidth they have to put pressure on the government as appropriate on those things? So let's come back to that question later. Meryam, always a delight to be on a panel with you. Meryam's got two different hats on, one of which is that she's the head of sustainable and responsible investment at Legal & General Investment Management, another leader in the field like Aviva, but she's also moonlighting, or I don't know what, part-time at the High Level Champions team, and therefore playing a key role around the mobilization of finance as we go into the COP. So she's definitely got a really good ringside view and also playing an influencing role in all of that. So Meryam, can you lay out what's going on in that arena and where that's taking us, and what maybe the gaps are still?
Sure, thanks for that, Catherine. So just kind of laying out what's happening within, so with my sort of COP high-level champion hat on, so what we're on is a race. It's a race to zero. And what we've done with the Race to Zero campaign is to kind of lay the foundation, let's say the floor, or where we need to be, like what we have to commit to. So we are saying to all non-state actors, so anything but the government, so cities, regions, universities, businesses, corporates, and investors and financial institutions, to commit to align their businesses to net zero by 2050, in line with 1.5 degree trajectory. And then once we sort of commit to the sort of the floor, if you like, of the bottom line, let's have a race. Let's have a race against each other. So what I love about it is that Aviva went 2040. Like we were committed to 2050 and they came in 2040. This is what makes a lot of businesses go further, because it's competition and it's a really healthy pressure. And that's what we want to create with the whole concept of Race to Zero. But also we have, when companies or anybody says it's net zero, there has to be a common standard. You can't just claim your net zero. You can't just use carbon offsetting and all sorts of things. So we're trying to put the structure in place so that we can speak the same language about what net zero is, and to just drive this ambition in the private sector so that we send a positive message to the government in order to have successful negotiations in November in Glasgow, and then every year from now on as well. So that's kind of the whole narrative of net zero. As you might have seen, we have net zero framework launched for asset owners, asset managers. Latest was the banks. We're working on insurance on the underwriting side, and Aviva's leading the way as well. personally working on investment consultants and many of the other aspects that are incredibly critical to make sure that the whole ecosystem or the financial system speak the same language. And what we've also launched is what we call GFAN, so Glasgow Financial Alliance for Net Zero, that sits above all of them. So you have to be part of Race to Zero to be part. You can't just kind of come into GFANs. But basically, once you have signed up to any of the network that sort of, you know, gives you the credit to be part of it, Race to Zero, then you're also part of this family called GFANs. And what it aims to do is to have the coordination amongst the financial systems. So to my point about the fact that there's a whole ecosystem there, asset managers can only shift capital if asset owners move. Asset managers also invested in banks and insurance companies, and we vote on them. We do capital allocation. So everything is linked. And when you have a project, it matters how the banking is financing, how the insurance comes in, and how the assets gets bought by the asset manager. So making sure that when we're talking about this net zero transition, we understand what the sort of commonalities are in terms of sectorial transitions that need to take place, but also the methodologies that are developing. Which answers to your second point, Catherine, what are the challenges? Huge challenges still, right? The science-based targets that's been set for financial institutions is at a very nascent stage. It needs a lot of work still for it to really meaningfully work as a methodology guideline. It's missing some parts of the businesses that we're operating. It's missing some asset classes and so forth. So we need to work on that together to make sure that we can't keep saying we can't do it because there's no methodology. We have to work on that together. We also have a huge amount of pressure to incorporate what we call scope 3, so the sort of indirect impact from obviously not the investments, but the underlying portfolio companies and what they're doing in their scope 3, their supply chain and products and so forth. Currently, that's not really incorporated into the investment decision-making process because data is either not there or incredibly poor. As you know, a lot of emissions are in scope 3. So for example, agriculture, 25% of global emissions. That's not incorporated in many of the investment decision-making process because we don't get that information from food companies and so forth. So we do, again, have to work together on this collective issues to incorporate the right information, the right data, so that it does get into the investment decision-making process and insurance process and loan facility process, all the different parts of the investment chain. And that's what we have to work. One other thing that I really want to emphasize here is that we can't just commit to 2050. That's 30 years away, right? We're not going to have the same job in 30 years' time, hopefully. And so we have to have an interim target. So that's at least as late as 2030, ideally earlier, to 2025 to 2030. So there has to be an action point that we do for today. Steve talked about working on it for 2 years, and we've been working on how do we shift the huge amount of pooled funds that we have for our clients into net zero options in the next 9 years. So this is kind of like an immediate actions that we have to have as part of this race that we've decided to be on. And so that's kind of the sort of big challenge for which there is no perfect data, for which there's no perfect methodology, but we have no choice but to be in the tent and figuring out together. And that's really the kind of the whole, even though I have 2 jobs and 2 hats, it's the same job because we're trying to do the same thing.
Thank you so much, Meryam. I'm just going to raise a couple of things that you might come back to. So one is just around, there's a lot of people that have signed up, and congratulations on, there's huge momentum. But at the same time, not everybody is in. I mean, we look at all the banks that were named in the net zero banking initiative or alliance, can't remember which one. And, some of the big American company banks that are massively involved in fossil fuel financing are not in the grouping. So what I'm wondering is, what's the cost to them of not being in the race? It seems to me we need some kind of a cost for not being in the race. But kind of corollary to that is, if you are in the race, how stretching is this? What's the cost of being in the race? So I just wonder if you can kind of tease out some of those dynamics. when we come back, because I think those are both really important to kind of how effective this is going to be and how credible it's going to be. So thank you, Meryam, brilliant. And now Nick Robbins, who I've known for a long time, partly because, well, he's done so many distinguished things in the field, but one of them is that he was the author of the Climate Change Committee's Road to Net Zero Finance report, which really laid out a pathway on this. But he's also a professor in practice at LSE's Grantham Institute, and he has many years in capital markets. So Nick, and also he's a tremendous champion of just transition and has really mobilized that concept and making sure that, you know, it wasn't just written into the Paris Agreement, but it's coming alive in all sorts of ways and will be central to the forthcoming Glasgow COP. So Nick, can you give your perspective on these debates that we've just been having, and particularly bringing communities and workers into the picture for us?
Well, thanks, Catherine, and really good to be part of this discussion and following Steve and Alex and Meryam and yourself. So I really actually just responding to one of the questions which we have from Ed Matthew about actually where does sort of regulation fit in this. We have huge, really positive momentum within the market with people setting these net zero targets. And as Meryam and Steve have said, how does those become real? One of the conclusions from this report that actually Steve was part of the group as well, that we did for the Committee on Climate Change as they developed their 6 carbon budget, was how do we relate this net zero target the UK has to the financial system? So the main conclusion, obviously, is if you want to deliver your net zero target, you need a net zero financial system. And particularly, you need to think about that the next 10 years, as Meryam has said, that we need to think about a 5-fold increase in real economy, net zero investment in homes, in transport, in agriculture, in industry and energy and so on. So this is not a smooth uptick in net zero investment. We need to 5-fold increase in real investment from 2020 to 2030, and then it keeps on going at about 50 billion a year in the UK. And alongside that, obviously, as you pointed out, Catherine, we need to phase down and phase out investments in fossil fuels. So no new fossil fuel investments, according to the IEA today. Obviously a big task for investors and shareholders and their stewardship capacity to make sure that the capex plans of the companies they own are actually in line with that commitment. So that's the sort of strategic issue, that we really need the financial system to be working for that net zero goal. And we therefore do need to think about financial regulation. So one of the proposals we made last December and has been sort of picked up is that we need to be thinking about the role of financial regulators, whether that's the Bank of England, prudential regulators, financial conduct authority, and so on, about contributing to delivering this net zero target for the UK. Really good to see the Chancellor changing the remit for the Bank of England, the Prudential Committee, the Financial Committee, the Monetary Policy Committee. Really good to have net zero and resilience in there, and hopefully we'll start seeing some changes in the way they're applying that to the assets that they purchase, the corporate bonds they purchase, and so on. So I think that could be a very key signal. But it also means in the way that they are supervising firms, because net zero can't just be one scenario amongst many. It's got to be the preferred scenario for the Bank of England. So as well as the TCFD disclosure, we do need, I think, to have mandatory net zero transition plans from regulated financial firms, from banks, from insurers, from asset managers, from pension funds as well. This, I think, will help in getting us to that consistent approach that Meryam highlighted. I think it will help highlight where there is greenwashing, which there could be. I don't think there is at the moment, but there could be that. And then crucially for the central bank, they need to see, does this all add up? Do all the net zero plans of all the insurers, all the banks and so on, does it add up to a net zero financial system and the system as a whole moving in the right direction? So I think in terms of what parliamentarians can do, the government can do, as we come forward with our net zero strategy this year on the road to COP, I think very clearly having mandatory transition plans for regulated financial firms would be a big step forward. alongside that, and this is, I think, where we start moving really particularly to the real economy, we need to make sure that all the funds, the pensions, the ISAs that clients of Steve and Meryam and others are making, that these are actually in real economy projects that are helping solve the climate problem, but also leading to jobs and renewal. So therefore, we also need other bits of public policy. We've got the new UK Infrastructure Bank, which is going to be headquartered in Leeds, a net zero target there, a goal of also of supporting local authorities. That could be a real engine of doing this. Perhaps we're going to need more capital there, but really making sure that actually the money that is in the city, let's say, metaphorically in London, is allocated through to communities and regions around the country. The British Business Bank, in the role it works with SMEs, going to be really crucial. And then the Green Sovereign Bond, which I think, Alex, you touched on. Again, that's going to be issued this year, perhaps next month. And that could be a real signal, a real catalyst to the financial sector about the importance of green finance. But I'm also really pleased the government said it's going to report on the social co-benefits of that bond in terms of jobs and levelling up and so on. And that takes me to our fourth piece, which is this point about just transition. I'm really struck, particularly after this terrible COVID crisis, how it's clear now that we need to connect net zero with the way in which we're going to deal with rising inequality in terms of region, in terms of gender, in terms of race, and so on. And it's really heartening to see how many investors are now incorporating just transition in their stewardship activities, encouraging companies to come forward with just transition plans. We've got SSC in this country, but also I think thinking about how their real assets investments, infrastructure investments, real estate investments how does it contribute to place-based investments? And this is something that we're working on with the University of Leeds, Andy Gouldson and so on, to think of how do we connect pension funds and investors with the place-based type investments that we're going to need to respond to particular priorities, whether that's in Leeds or in different parts of the country. So I think a lot of things we need to see. We need to have that net zero financial system. We need net zero financial regulation with this transition plan being put into law. We need those public institutions to help crowd in private capital. We need the just transition. But then I think we have this momentum. We have such an opportunity with the G7 this year, hosted by the UK, with COP. And we saw how the French financial community really used Paris to really move forward with their domestic agenda. And I think that's something we can do in the UK this year. So I think a lot to do, but a huge opportunity really in the next few months to put all these pieces together in the net zero strategy and make sure we can sort of hold our heads up high when we get to COP.
Thank you, Nick. I'm struck that I quite agree with you that what we need are sort of regulatory mandatory requirements for net zero transition plans, but we're a long way from that at the moment. It's very much, we're still in the realms of disclosure will do it. And I'm just wondering whether, given that you have a really good kind of perspective on the rest of the international scene, whether you're seeing other jurisdictions that are being kind of yet more ambitious in terms of what they're requiring of their finance sector. Maybe we can come back to that. I'm conscious that Alex may not have that long with us, so I want to pick up, if I may, Alex, on the question I left you with, which was kind of how are we going to really engage your peers across all the parties in this net zero focus, and particularly thinking about finance for net zero.
So I think I'm going to sort of make an analogy here. If we go back 100 years, if you were a company that in 1890 had been making carriages, by 1921 you'd have been out of business with the end transition. And we've got a lot of businesses now that are going to have to make the transition. And the first businesses to transition were the ones that weathered the storm the most successful. We're going to see that again. And so the finance sector and the state, in terms of the signals that it gives and the financial instruments that it's going to bring forward, are going to help that. And what we parliamentarians are most alive to are the jobs and livelihoods of our constituents. So where there are investment opportunities, whether that's blended investment by the state in the private sector, private sector investment, or even state investment, where it creates large-scale jobs is important. And we all talk about a green industrial revolution or transformation or renewal, or however we put it. And the proof in the pudding is going to be seeing, you know, the shovels in the ground, as the Prime Minister likes to say. And the finance sector is the prerequisite for us to get those shovels in the ground, that infrastructure built, and those jobs created. And I think that's what parliamentarians respond to. They think that they're going to get a project in their constituency, or one their constituents can travel to work in, then they'll support it. Otherwise, they'll continue to support dirty industry and old forms of production, because that's where their constituents work now. So the other aspect of that is obviously skills. So that is really the role of the state. And we now have a much more devolved country. We now have 11 metro mayors. We just elected another new one in my own region in West Yorkshire last week. And they all have responsibility for skills. So skilling people for the transition for net zero is going to become hugely important. You know, we've seen people in Teesside and on Merseyside and Greater Manchester lead on that, really. We're going to need to see that in all our regions, particularly the former industrial heartland. And again, that's the role of the state, but then we need the investment in the project for those people who are skilled up to go to.
And Alex, obviously skills was a key agenda in the Queen's speech, which is positive, but inevitably the transition will generate I think overall net gains for jobs, but there'll be winners and losers in different constituencies. And I just wonder, kind of, what is the policy thinking around how we incentivize the transition in areas where there could be short-term quite significant damage to jobs from the urgency of the transition. I mean, Nick laid it out. We've got to have incredibly rapid scale up of green, which is great, but equally well we've got to withdraw from brown and high carbon, or transition some of those. So is there enough, do you think, in play in terms of how we ensure that some of those who may lose out in the short term are going to be supported by government action and policy action?
I think you talk about winners and losers. Everywhere where we're looking at losers, they're leaving behind big industrial brownfield sites. So those sites are there really to be developed into the green sites of tomorrow. If you've got a coal-fired power station, your coal-fired power station is flat. You've got a huge brownfield site which has got good transport links to it. There are lots of other opportunities for sites like that. If you've got onshore oil and gas refineries, again, big brownfield sites with good transport links. If you've got car manufacturing, they've got the Bridgend plant in South Wales, that needs to be transitioned in, the Welsh government are working on that to new, to electric battery production, or, some form of green manufacturing. I don't think there's many places where there's industrial production where they can't be part of the transition. I think we need to see it as an opportunity. And the only real barrier is that some of the production, because of technology, will be less labour intensive. And so that's where we need to try and provide other jobs. But again, it's the whole supply chain. So we need to be trying to ensure some of that supply chain to provide those jobs.
Okay, that's really clear and great. Thank you, Alex. Now I want to just open up this whole discussion about, we've heard a lot about from Steve and from Meryam in particular about some very dynamic and ambitious, but albeit voluntary initiatives from the finance sector. And I think it's worth just getting into this debate that, ultimately, is that going to be enough? And do we need players in the finance sector who are really engaged with this, supporting and enabling and informing our parliamentarians to actually move at greater pace towards the sort of mandatory standards that are ultimately going to be needed to achieve the transition at the pace required, which is now, we've all left it so late, we all know that. So Steve and Meryam, can you just give your thoughts on, at what point is voluntary not enough? Even though acknowledging the huge dynamism and recognizing, thanking really those in the finance industry that have been stepping up, but is it enough? And what do you see as the kind of conversation needed between experts like you in the finance sector and people like Alex, who are legislators and can take us to the next level if assuming we need that. Steve first.
Thank you, Catherine. Meryam, I know will add a lot to this. Voluntary has never been enough. It was never enough when it was originally suggested in the 90s. It was not enough when we were calling for it to be mandatory in, I think it was 2006, mandatory disclosure of carbon emissions. We know that voluntary only works for the leaders, and the laggards with a brand come kicking and screaming maybe eventually, but those without a brand and those that do B2B and those that are listed overseas, you know, they don't move. So voluntary has never been enough at all. And I don't think regulation is enough either. What we need is a coherent package of how you make the polluter pay at the core, so the cost of carbon is actually reflected in the cost of capital. And so as policymakers, there are 5 tools they should be exploring to their fullest extent. 1, fiscal, so changing the subsidies and the tax framework. 2, we then need the regulation framework in the real economy to make sure it costs the polluter. 3, we then need standards to say if you're going to do something, it needs to be done in this way. It's not a regulation, that's a standard. 4, there's emissions trading schemes, so market mechanisms. And then 5, consumer awareness. Those are the 5 tools. If you've got like product labeling and aware consumers, they can then demand something that they want. For example, if you have better product labeling on financial services consumers who tend to be sold the product rather than buy what they wanted. That's how it works because of the asymmetry of information in this industry, in finance. If there was better product labeling and better awareness of the consumers, that would be an important measure too. So this debate about whether it's voluntary or regulatory is completely redundant. It has to be a combination of those 5 tools that internalize the externality, and it has to be applied at the real economy first to harness the profit motive, and then in the financial services sector so that consumers of financial services are aware of what they're buying and what's being done with their money in their name. That's a coherent and comprehensive package. So it's not voluntary or regulatory anymore. It's everything. And voluntarism has got a lot of people joining the Net Zero Club, which is brilliant and probably the right place to hand over to Meryam.
I want to come back to you on fiscal. So let's just hold that, because you put that number 1 and you also identified it earlier as the bit that's really badly missing. So come back to you on that. Meryam.
Well, I'm going to completely echo with that. It's a very comprehensive list. But what I wanted to say is, yeah, something like carbon price or carbon tax, however we want to kind of frame it. We've been talking about it for a long time. We do have a floor price, which is pretty low, but we really need visibility of where it's going, as I say, for 2025, 2030, 2040. Because what's happening in the financial system is that we all starting to have these models to put in to stress test our portfolio, our securities that we hold and so forth. And the easiest way to stress test is to put a carbon price in. But it's all kind of, it sort of swings from 15 pounds to like 200 pounds. I mean, it's crazy amount of range that we're talking. We need visibility of how these things kind of get ratcheted up so we can actually put it into the finance model and invest accordingly. So that kind of vision that the government can, state now that we, unfortunately out of the EU, we need to be able to give visibility of the future for people for the financial system to start to allocate accordingly. So that's kind of one thing. The other thing I want to say, in addition to everything else that's been said, is, and I think it's already been said as well, just to kind of sort of say, you can't just take financial institutions to divest out of one thing and put that money into the solutions. That's not how money moves, right? In order to invest into a lot of solutions, whether it be nature-based solutions, whether it be green hydrogen, a lot of those technologies, it's a very, very different kind of capacity that we have to build. And what's actually stopping us is also the existing regulations in terms of kind of false comfort we get from liquidity, or, all the right reasons the regulations are in place for insurance companies, the banks and pension schemes are the very thing that are stopping us from really building the right capacity to invest. And we're all trying to do that on the edge, but it's really tinkering around the edge. The scale of the trillions that need to be mobilized means that we have to think about how we assess risks for financial institutions as a whole. So it's not that, mandatory, voluntary, yes or that, but is the regulation we have for financial, institution fit for purpose to mobilize trillions? No, it's not. And we have to have that conversation as well.
Okay, that's a perfect segue to bring Nick in, because Nick's very involved in and observing and contributing to the debates about central banks, where, there's a whole club now, the NGFS, there's lots of, but frankly, there's still quite a timidity, it seems to me anyway, and really central banking and supervision isn't really stretching to the extent needed to lay the rules that enable this transition. Is that a fair assessment?
I think probably central banking does need to make the same shift that the private financial sector, as we've heard today, from just looking at sort of climate risk as something which is kind of notional to net zero commitment, which is not notional. It is about restructuring your portfolios and so on. I think central banks are on the cusp. In the UK, we've obviously had the signal from the Chancellor, from the government about the remit. I think we're going to see the ECB move next. There's lots of sort of signals coming out of that. And I think the real issue is going to be I think central banks recognizing that from a core risk point of view, in terms of the financial stability of the system, net zero is the best option, and therefore it is in their mandate to actually ensure that the financial system and the firms that are within it, whether that's insurance firms or asset managers and so on, are actually aligned to that. There's a fundamental risk reason for that. And I think also what I'm finding talking to central bankers is this notion, this sort of new notion, which is a bit of jargon, but this idea of double materiality really works for central bankers, because in a sense, double materiality is not just thinking about the materiality of sort of environment on you, but the impact you have on the environment. Now, if you're a central banker, you capture all that risk at the system level. So you are interested in making sure that individual firms are doing net zero, but you really want to make sure you have a net zero financial system as well. So I'm seeing that as a change, and people realizing that they can't just keep on with their same asset purchase schemes and buying assets without considering the carbon performance. They really, because they hold the financial system as a whole, then they need to be actually changing the way they're buying bonds and intervening in the market. So I think this is going to be coming, and this is what I think central banks need to do alongside these net zero commitments. And therefore, one of the proposals we made in the report, which Steve was part of, for sort of mandatory financial firms having to make net zero transition plans on a mandatory basis.
Yeah, I'm not following the central bank discussion enough. I mean, could we anticipate something really bold out of central banks before COP in a helpful way, or is it going to come after? Nick?
Well, we see we've got the Fed back in action, so I think that's moving, which is good. China is moving as well, and really interesting listening to their Governor Yi from China. And again, maybe just to throw something in, is that in the UK, our CO2 emissions peaked in 1973. So we have a relatively gentle slope to 2050 phase out. China potentially has 30 years. And so they're really realizing this is super fast. This is essentially transition in effectively one generation. Yeah. So they're really starting to think about what they need to do in terms of their economy, where obviously still new coal-fired power stations are being built and so on. So a big shift there. So I think next step will be the ECB, but don't forget the Fed, don't forget China.
Gosh, it does, the mind boggles at the just transition implications for China. Steve, can we come back to this question around fiscal policy measures? Because that's a nice little word, fiscal, could cover a huge range of interventions in practice. Can you talk through a little bit what you see as some of the, and we talked about carbon pricing, but could go well beyond that, couldn't it? What do you think are some of the interventions that would really move the needle fiscally?
You're right, Catherine. It could apply to lots of things, and it should apply to lots of things. So Meryam's referred to the floor, the price that we have. Last time I looked at about £18 in the UK. That floor needs to be raised. On top of that, you can have tradable permits. But that combination of fiscal and market mechanism can be augmented with I really loved Meryam's point. I tried to flag this in the chat just now, having forward guidance from a credible institution like the central bank, like the Chancellor, saying this is where we expect cost of carbon to be in 5, 10, 15, 20 years, because this is what we're going to need it to be for it to manage that transition. That policy would be wonderful. That forward guidance wouldn't have to be a political reality today, which obviously would be harder, but would be a reality if it's credible in people's cash flow analysis, the discount cash flow models, and therefore start pumping capital in the right direction. So it's important that it's credible and that it's delivered, otherwise it will lose its meaning. But just as forward guidance in other areas is incredibly powerful, forward guidance here from the same institutions would be similarly powerful. But to answer your specific question, I was trying to really, if people take just one thing away from today that they could do in the UK, that would be it. Excellent suggestion, Meryam. But to come back to your question, Nick and I have talked before about this idea. In the EU, the producer responsibility regulations that exist for packaging, for waste electronic equipment, for end-of-life vehicles, for car tires and so on, all these visible waste streams, there is a requirement on the producers and the manufacturers and the distributors to fund the recovery at the end of the life. That's how we pay for curbside collection. That's how we pay for the recovery of white goods and so on. That's why there are so many take-back schemes from large manufacturers. Now that regulation has worked in the physical environment. We need it as well in the atmospheric space. We need to make sure that the polluter pays and that the fossil fuel sector has to finance the recovery of these emissions. So that's a fiscal measure. You can have that then hypothecated, the revenue that comes in, and you can use that hypothecated. You could do that through tax, or you could do that through a regulation. You could then hypothecate the revenues and finance the individuals, the transition at the household and the community level for those people that need to retool, re-kit, re-educate themselves. And you could have a whole world of reaching into communities that will be suffering otherwise using that revenue. But most importantly, it would generate the billions that are required for CCS. And at the moment, we're all talking about different types of CCS when the original form of CCS was never at scale. So real economy, it should start with making the polluter pay. Then you get the cost of capital reflecting the cost of carbon. Then all our capital flows in the right direction as a consequence. It becomes a virtuous circle, but for as long as it pays someone somewhere to do the wrong thing, someone somewhere will do the wrong thing. It's like a giant Stanford marshmallow test for the whole world. We need to change the equation, and that's what fiscal does. Long answer, Catherine, sorry.
No, fantastic answer, fantastic answer. I'm pondering on it. I'm thinking, actually one of the reasons maybe some of that hasn't happened is that some of the big polluters are also pretty active in the public policy space and have been, quite busy making the case that maybe we're moving too fast on some of those things, or that there's not a case for it. And I wonder how much you see a role for financial services, being more bold in what it proposes at a public policy level around this agenda. Like, I know we've got the Institutional Investors Group on Climate Change, which was established, I don't know how many years ago, 15 years ago, something. It's been around for a while, which is a policy engagement channel for people in finance with an interest in climate change. But it strikes me that some of the kind of solutions that you've all been talking about really need to be amplified and brought to policymakers in conjunction with sympathetic parliamentarians in a rather more robust way than we've done hitherto, because there is, of course, countervailing lobbying from those who in the short term see no advantage in a fossil fuel sector having to clean up and pay up. In the meantime, we still have very big tax revenues paid by high carbon sectors. So there are lots of sort of tensions, and it always strikes me that there's even more room for the finance sector to be bold. I think all three of you have been highly engaged, which is the reason you're on this panel today, in public policy advocacy. But can I just ask all three of you quickly what role you see further for the finance sector to help shape the regulatory environment that will bring us where we need to get to? Nick, why don't I start with you on that?
Well, I think that's already happening. It's really good to see that a number of investors have signed a letter to the Prime Minister actually calling for this net zero financial system, Aviva, Legal and General, Federated Hermes, and so on. So I think recognizing that we do need this system shift, and actually that this is an opportunity as well. This is a necessity, but we need to get all these system pieces going together. I think also finance, to build on what you're saying, does have a role in the sense of actually standing by the interests of the clients and beneficiaries. And in some senses, although we have benchmarks and so on, are less beholden to particular assets and so on. I think can have that longer term view. And therefore also it's really good to see in initiatives such as the Climate Action 100 and others, investors really focusing on the lobbying of the companies they own. Mm-hmm. So actually drilling through to that. But I think in terms of expectations of citizens who support net zero through the Citizens Assembly, want it to be fair, want to have choice, I think they'll be expecting their financial providers to be working with government to put all those policies in place. This is a market failure. It needs policy reform.
Meryam, just sort of 30 seconds or at most 60 for you closing.
Yeah, I mean, I think I agree with that. But one thing I do caution is I don't think financial institutions have been good at advocating for really progressive policies on this en masse. And so we have to take it with a bit of a pinch of salt about, and are they the best institutions to be lobbying the right kind of policies that make sense for net zero when they haven't really quite grasp what that transition is yet. Maybe I shouldn't say this in the forum, but I think it's true. And so I think we have to make sure that from a policy perspective and a regulations perspective, we really anchor to science and what is possible and what needs to be done. And that, that it's not too much on the lobbying side, but it's about what needs to be done and then built from there. Where I think the financial institutions have to be talking to the government a lot more is exactly the kind of incentives, so whether it be carbon price or whatever it might be, the financial mechanism to make it financeable. That's where the conversation needs to happen, because the governments are not really used to kind of understanding the intricacies of that. And I don't think the financial institutions are used to actually telling them exactly what they need. They're very good at complaining, but they don't actually tell them exactly what they want. So we do need to create that forum. But when it comes to net zero transition, let's make it pure in terms of what needs to happen, because there's so much conflict of interest in the system. We just have to be careful. So that's the little bit of caution there.
Okay. Well, I suppose that's exactly why I feel we need the counter voice, and that we anyway, I think finance must speak up, precisely because other people are busy speaking up to slow things down. Steve, final word. It's 5 o'clock. We might find people are drifting away. So please be swift, but I want to give you the last word on the panel.
Catherine, thank you. That was very kind. Every investor now claims to integrate ESG and engage on it. That's a great fact that 15 years ago wasn't true. There's a whole series of reasons why that is true. However, there are very, very big and very important limits to integration and engagement. And in the presence of market failure, no amount of integration or engagement is going to motivate the right kind of behavior on a sustainable basis for the long term. You have to engage with governments to get them to correct the market failure. I think all investors in the UK and some elsewhere, particularly in Europe, have a duty to maintain market integrity. Integrity isn't just a not mis-selling thing and a not front running and a not using insider trading. It's also about maintaining the system integrity. And when something like climate change is challenging that, I think we need to be thinking what the duty to maintain market integrity looks like. And that means stewardship at the macro level, not just micro with individual companies. Macro stewardship, we need to reset the rules of the game together. And some of the insurance companies and others in finance that are longer term recognize that. And I agree with Meryam that it's not all of finance by any means, but those that are existentially exposed, insurers particularly, they really have a duty to clients and shareholders, as well as the regulator in this form of the duty to maintain market integrity. There's in another APPG another time, Catherine. So back to you.
Great. I love that phrase, macro stewardship. I think that's absolutely what we need. It's just worth saying ShareAction is about to bring out a global assessment of insurance companies, the largest in the world, looking at how they're doing. And there's that I can guarantee will be an interesting read, because there's very, very variable performance, unfortunately, on climate in the global insurance sector, as we will see in more detail when that comes out. So I want to thank everybody on the panel. I'm sorry we lost Alex halfway through, but we could hear it sounded fun in the cafe he was sitting in. There was a lot of laughter up in Manchester, people enjoying being inside a cafe. But thank you to everyone that tuned in. Thank you so much to Meryam, Nick and Steve. As I said, look out for E3G's forthcoming parliamentary briefing on net zero finance, which I think will be a must read. And just keep tuning in to events that we're running as part of the APPG on sustainable finance. We're really looking to be an absolute hub of debate, bringing together people in Parliament with people in the finance industry to help get the right policy solutions to take us to net zero. So thank you all and have a good afternoon.